Welcome everybody to our 22nd spread event. For those returning, welcome back. And for any newcomers, SPREAD stands for Supporting Peer Respect, Education, and Discourse. We are a community of learning. We come together to expand our perspectives and to just stay curious about the world. Our goal is simply to build a community and to support each other throughout life in general. We try to bring you relevant topics as well as to provide a space for anyone to develop as speakers and communicators. Today, we are honored to have Anna Liang, an accountant who concentrated in accounting when she earned her undergraduate degree in business administration at the University of San Francisco, and who recently passed all 4 of the uniform certified public accountant examinations. Anna's here with us today to discuss personal income taxes. This always relevant topic will be a constant event for the rest of our lives, so we might as well understand what it is we're doing every April. Again, you may consider having a copy of your own taxes in front of you in order to look things through, something like that. So welcome again, guys, and without further ado, here's Anna with personal income taxes.
Okay, hi everybody, I'm Anna. Let me share my presentation. Today I'm going to be sharing with you guys the basics of personal income taxes. And income tax is a very important topic, as Stephen mentioned, because if you make money, you'll have to file taxes. And whether you file your own taxes or not, everyone should have a basic understanding of what income taxes are and how it impacts them. Now, I'm not a licensed CPA, and some of you may even be more knowledgeable than me, but the only way we can become more knowledgeable about taxes is to become more informed. The presentation will be around 1.5 hours, 2 hours for questions, so feel free to leave if you need to. But let's start the presentation with a little icebreaker. So if you are available, please kindly log on to slido.com and enter code 00022. And we're going to be using this platform throughout the presentation, so feel free to keep it open. And once you guys are there, you should be getting a question. The question asks, what do you hope to gain from the presentation? The first option is I want to learn a lot. Second is I want to have fun. And 3, I have specific questions. So you can choose multiple if it applies to you. So we have 6 responses right now. A lot of people just want to have fun. A lot of people want to learn a lot. Some people have specific questions. So that's good. I'll give it another minute or a couple seconds. Oh, more people want to have fun than they want to learn. It just gets getting higher. All right, I think we're good. Everyone wants to have fun, and I'm here to have fun to teach you guys about this stuff or share what I know. And hopefully you guys will learn a lot, or at least a little bit more than you did before. So let's go on with the presentation. Oh, by the way, if you have any questions, feel free to click over into the Q&A tab, and you can type your questions and enter them, and they will show up here for me in the Q&A. So if you have any questions, it'll pop up here. And you can do this throughout the presentation, and we will check in on them during our checkpoints. Okay, moving on now to the overview. So we'll be discussing a couple of things, but let's start with what we're going to be talking about. The first thing we'll be talking about is what taxes are, how to pay them next. You can pay them through with employer withholdings, estimated taxes. We'll also be discussing the income tax formula and steps to calculate your income taxes, including determining your filing status, any deductions and credits, as well as your tax liability. And lastly, we'll also go over any tax forms. So what are taxes? Tax is money collected from taxpayers to fund government spending. In other words, your money keeps the government running. Now, if you think about it, governments don't really have a revenue stream like companies do. If you think for San Francisco's local government, like sure, we have muni, we have public utilities and other fees, but it's not really enough to sustain an entire government. That's why taxes are the main source of revenue, and you can think of taxes as really an investment to your community. There are generally 3 types of taxes. There are a lot of taxes, but we can group them into 3 categories. The first one being taxes on earnings. So this is tax on money people make. First one being income taxes, and that's what we'll be discussing, specifically personal income taxes, so meaning individuals. But corporations also have to pay income taxes and file income tax returns. There's also something called capital gain taxes for those who have investments. You probably know that if you hold investments for a certain period of time and you make a sale, you have to pay capital gains, and there's or you make a capital gain, you have to pay taxes on that. There's also taxes on buying, and this is probably the most relevant tax on this slide to most people here, specifically sales tax. So everyone pays sales tax, right? If you buy something that's taxable, you have to pay sales tax. And different counties have different tax rates. If you didn't know, tax rates actually went up on July 1st. And in San Francisco, we used to be at an 8.5% tax rate, and now we're at 8.625. So a little bit of an increase, but not as high, surprisingly, as our surrounding counties. So if you buy something that's taxable, maybe consider buying in San Francisco. And lastly, there's taxes on ownership. So this is taxes on owning something. If you own property in anywhere, really, you have to pay property taxes to your local government. And a portion of that goes to the state. And over here on the right-hand side, I have the logos of the various taxing authorities. So on the right here, we have the IRS, which stands for Internal Revenue Service, right? The California's taxing authority is the Franchise Tax Board, or FTB. And at the local San Francisco level, I'm sorry for anyone not in San Francisco County, but in San Francisco, the taxing authority is the Treasurer and Tax Collector's Office, and that's their logo. And I wanted to show you how much tax our local and state governments actually collect in a year. So starting with California, this is the, I'm sorry if you can't see, but this is a chart comparing the tax revenue between fiscal year June 30th, 2019 and 2018. So you can see here that personal income taxes make up probably half of the total tax revenue for California. And this is actually in billions. So if you can't read that, in 2019, June 30th, 2019, personal income taxes make up $96.8 billion of California's tax revenue. Second comes in sales and use tax. So you can see that income taxes make up a huge chunk of state revenue. And this is actually from their annual financial report. It's open to the public, so you can look this up yourself if you want to. And governments typically have a fiscal year end. So what that means is that instead of a calendar year end like we would have, which is our year starts in January and ends in December, for governments, typically their year starts in July 1st and ends in June 30th. So that's what it means. So again, that's right here. And these are other revenues that the state makes in their government fund. And in San Francisco, San Francisco's main source of government revenue, at least for June 30th, 2020, are property taxes. So this is in thousands, so that's $2.6 billion in property taxes out of $7.1 billion of total revenue. So this is just the government fund. There's other funds that the city has, but this is just like the general fund, if you know what that is. So San Francisco doesn't collect income taxes. Property taxes is their main source of tax revenue. So I'm going to be referencing the overview slide as kind of a roadmap to see and for you to follow where we are and where we're going to go. So we talked about what taxes are, and now let's talk about how to pay taxes. When do I pay taxes? So the IRS actually requires income taxes. Oh, by the way, when I say IRS, I also mean California. So going forward in this presentation, when I say IRS, I mean both federal and state. So the the IRS requires income taxes to be paid as income is earned. So whenever you make money, you should be paying taxes at the same time. It's a pay-as-you-go system. And the most common way we pay taxes while we make money is through payroll withholdings. And what that means is your employer takes taxes out of your paycheck and submits them on your behalf to the taxing authorities. So that way you don't have to pay the government when you make the money, right? Your boss takes it on your behalf and they submit it on your behalf, saving you time and the government being able to get their money ASAP. Another way to pay as you earn are quarterly estimated taxes. And this is for people who maybe are self-employed or they're not employed by traditional means, or they are employed and they make a lot of money on the side, right? And this side money isn't taxed yet. So you would have to calculate your quarterly estimated taxes and submit them yourself to the government. It's self-filed and self-paid, which is due 15 days after each quarter. And we'll go through what payroll withholding and quarterly estimated taxes are. So we can save questions for later if you have any. Another way to pay as you earn are optional withholdings. So certain transactions, they may ask you if you choose to withhold taxes from your income. And probably the most common one is unemployment benefits. If anyone is getting unemployment benefits right now, the state does ask if you want to withhold federal taxes from your unemployment pay. And depending on what you need or not, then you may choose to withhold or not. And last option, you can pay taxes when you file your tax returns. But keep in mind that there may be penalties, and we'll go through what those are in later on the presentation. But really, at the end of the day, the IRS isn't going to, take you to jail or do anything bad if you don't pay your taxes right when you make money. They give you leniency, especially for individual filers. So really, it is a delicate balance between overpaying, which in a sense you're giving a free loan to the IRS, right? Because when you file your tax returns and you get that money back, you don't get interest on it. So the government you just gave them a free loan. Or you can underpay and you'll just have to pay the penalties. So it's really a balance between what you need and whether you want to pay the penalties or not. So let's start with discussing payroll withholding. And payroll withholding, remember, is your employer is taking taxes out of your paycheck. And there's a lot of names for it. It's mainly called payroll withholding, but people also call them payroll taxes. People call them employer withholdings, call them payroll deductions. They all mean the same thing. And when your employer takes money out of your paycheck, they're actually taking out two types of taxes. They're taking out income taxes and FICA taxes. So income taxes, as you know, it goes towards your tax returns. It goes towards taxes on earnings, right? Because you have to pay taxes when you make money. So they're taking that money out of your paycheck and giving it to IRS ahead of time. But there's also another thing that they take out of your paycheck, and it's called FICA taxes. And what FICA taxes are, it's an acronym for Federal Insurance Contributions Act. And basically, these are taxes for Medicare and Social Security. And California actually has another tax that they take out of your paycheck, and it's called the California State Disability Insurance. And what that is if you have maternity, paternity leave that's paid through the state, or if you were hurt in a way where you can't work, you can file for state disability insurance. And all these are taxpayer contributions towards these sort of welfare benefits. So if you don't know, Medicare is kind of like government insurance, healthcare insurance, and Social Security is revenue that you hope to get when you retire because you've been contributing as you're working. And I wanted to show you what the FICA tax rates are. So on the left-hand column here, I have filing statuses. And filing status is what you report to the IRS as your marital status, really. And we'll go over what those are later, but generally it's just whether you're married or you're single or you have a family and you're not married, let's say. So in the single and married, they are the same rate, but there's different thresholds. Under Medicare, it's actually 1.45% on your income, on how much you make. So 1.45% of it goes towards Medicare. But if you make more than 200,000 or 250 if you're married, then you have to pay an extra 0.04%. And for Social Security, it's 6.2% only on your first $142,800 earned. So anything you make more than that, it's not taxed for Social Security anymore. And right here under responsible party, for FICA taxes, you pay half and your employer pays half. Does that mean half on 6.2 and 1.5? No, because if you look on the bottom row here for self-employed, if you're self-employed, meaning you don't have an employer, you have to pay the full amount, which is double if you were to be working. So if you're self-employed, it's 2.9% of Medicare taxes and 12.4 for Social Security. So that's something to consider whether you want to be unemployed or self-employed. Because if you're employed, your employer pays half of the Medicare and Social Security taxes. But if you're self-employed, you have to pay the entire amount. But there is a deduction for that, for the other half. But it might be better if your employer just pays it, right? So here's an example of a pay stub from 2019. This person's named Sylvia. I just wanted to show you what it looks like on the paycheck, what these deductions look like. So you can see here that she made $880 before taxes. But then she has to deduct, or the employer deducts this much tax, $260.12 from her paycheck. So right here, under deductions on the right-hand side, it's FICA Med tax, and that's Medicare tax. FICA SS tax, that's Social Security tax. Fed tax is federal income tax. CAST tax is California state income tax. And SDI is the California State Disability Insurance tax. So these are typical ways that your employer or third-party payroll paycheck distributor would use these acronyms. So if you ever look at your paycheck and you're like, what are these? What does this even mean? Hopefully now you know, right? And you can see that she made $880, but she only got to take home $619.88. So $260.12. Part of it goes towards her income taxes, but part of it goes towards Medicare, Social Security, and disability insurance. And you might ask now, how does my employer even know how much to take out of my paycheck for income taxes? It's like, okay, well, they know how much to take for FICA, but what about income taxes? Well, they actually know how much to take out because of this form you filled out when you're first employed, which is the Form W-4 form. And the full name is Employees Withholding Certificate. You fill it out when you first start your job, and they would use this form to compute how much should be taken from your paycheck. It's actually one of the required forms when you first start your job. And maybe you didn't know this, but you can update it throughout the year by filling out a new form and giving it to your HR personnel or payroll department. And what determines how much to take out of your paycheck are a couple of things. Firstly, your filing status. Remember, whether you're single or married, or maybe you have a household with and you're not married, or also the number of dependents and jobs you work. And the more beneficial your filing status is, meaning married is typically more beneficial than single, and the higher number of jobs and dependents you have, the less is withheld, because the government understands how difficult it is for people to have children or have dependents to take care of, so they'll let you take home more money now, but also because it's a more beneficial filing status, meaning that you might pay less taxes. So they have a delicate calculation, and the payroll department of your company or accountants, they will figure this out and take the adequate amount from your paycheck. So this is what the Form W-4 looks like. In step 1, you would just enter your basic information, but step 1C is where you would check your filing status, right? Whatever filing status you are. And single doesn't mean like whether you have a significant other, it means whether you're married or not. Step 2, you would check the box in C if you have multiple jobs. And whenever you're filling this form, you should definitely read this over to see if anything applies to you. But for presentation purposes, I'm just simplifying the process. In step 3, you would enter the number of dependents you have. And there's actually a step 4, but we'll talk about that later when we talk about estimated taxes. So right now, I'm going to stop for questions if anybody has any, but first I'm going to check the Slido to see if anybody put any slides in the Q&A or questions in the Q&A.
Yeah, we have a bunch.
Yes, we do. Okay, first, let's go through this. Sales taxes are higher in other Bay Area counties. How much higher? It's different for every county, and I'm not too sure because I haven't been leaving my house, but typically it's higher than 9%. That's what I've been seeing as a trend throughout the Bay Area. It's like 9% and higher.
Yeah, I looked it up. San Mateo, like the main cities, San Mateo sales tax 9.6%, South San Francisco 9.8%. Where else do people go? Burlingame 9.6. I don't know what Marin County is up north. Marin County, I don't know. I don't recognize most of these towns. Sausalito is 8.7. So some cities in Marin County are lower if you want to cross the Golden Gate Bridge to shop over there. But yeah.
Okay, cool. Hope that answered your question. How did revenues from property taxes decrease in SF and elsewhere? How did revenue property taxes decrease? Well, remember how San Francisco is governments are on a fiscal year. So it runs from July of 2020 ending, it runs from July 2019 all the way to June 2020. And you know how the pandemic started in February, March? I think San Francisco may have extended their due date for property taxes, or if they didn't, then maybe they didn't pay it on time because of the pandemic. So maybe it's counted in July 2020, right? So the revenue wasn't counted yet. Hope that answered your question.
Generally, it doesn't go down, right?
No, it does not go down unless your house burned down. They have to reassess your house value. But yeah, like typically your property tax rate is going to be the same, but the revenue might be lower from that report because of the pandemic. That's my guess. Because if you saw that slide, like I'll show you the slide. A lot of the taxes were lower in general, right? In 2020, the revenue was lower by $5 billion because of the economy as well. Okay. Hope that answered the question. Pay-as-you-go system as opposed to what other model of taxation? I mean, in the US, we do pay-as-you-go. I don't know about other counties, but in China, I mean, you don't even have to pay taxes if you don't make a lot of money or you don't have businesses. So there's other models of taxation. There's like progressive taxation, where I don't know whether you have to pay it as you earn, but definitely like the way they tax it is different. But pay-as-you-go system just means like when you make the money, you have to pay it versus paying it at the end of the year or something like that. Hope that answers the question. Maternity and paternity leaves follow under CASDI. Yes, I believe so. You'd have to file a request, I believe, if you want to get the maternity paternity leave under state disability. It's called state disability, but it's a huge umbrella for a variety of like benefits where you can't work because of certain health reasons, right? Maternity and paternity being that. And you can only really get it if you aren't being paid through your employer. If your employer has a maternity paternity leave program, then you cannot double dip into the state benefits. If my employer withhold part of my income to pay tax to the government, why do I still have to file taxes in April, assuming I don't have stocks, property, etc.? The reasons why we have to file tax returns is because you are basically certifying to the government that that is the amount you made, and that this is how much I paid, and this is how much I owe in taxes and how much I don't have to pay now because you already took from me, and how much you have to pay me back, right? Especially if you want your refund, you have to file a tax return. They're not just going to give you the money back at the end of the year. Especially, and like you might qualify for credits and deductions that the government doesn't know about. That's why we have to file taxes. What's an example of determining how much to withhold on my W-4? How much do you withhold? I would say that if you aren't married and don't have a lot of financial liabilities, I would just say I'm single and I don't have any dependents and I don't work another job so that I can get a return at the end when I file my taxes, because I don't really like to owe the government money and I don't want to pay any penalties and I don't need the money now. So it really depends on your financial needs and your financial means and whether you need the money now or you don't mind getting the money back later. Is it better to withhold more and collect the amount after filing taxes? I personally prefer to do that, but again, it depends on your financial needs. If you want the money now versus money later. Okay, I think that goes through our Q&A. Oops. Let's go back to the presentation. Where were we? We were here. So we went through employers taking money out of your paycheck. Now, what about if you aren't employed or you make a lot of money through investments or some other means and you didn't pay taxes on it? Remember, the IRS requires to pay taxes as you make money. So you should be paying estimated taxes if you think you need to pay the IRS more than $1,000 at the end of the year. Otherwise, there might be a penalty. However, you can avoid the penalty by either paying 90% of last year's tax liability or 100% of your current year's tax liability. And tax liability is just the amount of taxes that you're responsible for at the end of the year. So this is before considering all the amount that took out of your paycheck already, which is a payment, right? So before considering all the payments that you already made, how much do you owe the IRS? That's what your tax liability is. But again, you can avoid the penalty by looking at your last year's tax liability and pay 90% of that, or you can pay 100% of what you think is going to be your current year's tax liability. And how would you calculate your estimated taxes? Well, they're calculated like how you would calculate income taxes. And I know that's not a good answer right now, but we'll talk about how to calculate it later. Basically, high level, you just need to take the amount that you know so far for certain. So you know how much you made this much so far in your paychecks. So you would need your earnings, your withholdings. If you know you qualify for deductions, if you know you qualify for credits, you can consider that. You also need your effective tax rate, or you look at something called the tax table. You take all that, estimate it for the whole entire year, divide it by 4, and that's how much you're supposed to be paying in estimated taxes for that quarter. And there are exceptions to this rule, and you really should look at Form 1040-ES for more information, but generally this is how you would calculate your estimated taxes. And keep in mind, this is a payment paid every quarter. So a quarter, by the way, is a year divided by 4, right? So January to March is one quarter, quarter 1. April to June would be quarter 2. So in quarter 1, you estimated for the whole year. But let's say in quarter 2, you suddenly had a big gain on your investments, or you change a job that pays less or pays more, or maybe you qualify for other deductions now. You'd have to recalculate your estimated tax liability for the whole entire year and redo the calculation and divide it by 4 again and pay a different amount. So you'd have to recalculate it every quarter. Keep that in mind. And this is what the form looks like when you file your estimated taxes. It's due 15 days after the end of the previous quarter. So for example, in quarter 1, which is January to March, it's due 15 days after the end of March would be April 15. And this is for, this particular form is for Q1. Basically, you fill out this basic information. Mainly, it's your social security number, your name, address, and how much you're paying. You can either pay by check or money order, but nowadays, honestly, you can pay online. And they probably prefer you to pay online because they get the money faster. So that's one way to pay your estimated taxes. But an alternative way is, remember your W-4, there's a step 4. This is the step 4. This is another way you can pay estimated taxes by telling your employer to take out the money from your paycheck. So under here in C, extra withholding, you can write down how much you want to withhold extra from your paycheck each pay period. So if you know you make a lot of side money and a specific amount of side money each pay period, then you could put that in here. And remember, you can update your W-4 whenever you need to. So if your employer is giving you a hard time, they really shouldn't. But you're legally allowed to give them a new W-4 whenever you need to. All right, let's do a knowledge check. It would be on Slido. Let me just go to the right slide. Oh no. Give me a second. All right, here you go. The IRS requires most of your income taxes to be paid at the end of the year when you file your tax returns or as you receive money. All right. We got 4 people for as you receive money, another for when you file your tax returns. Remember, we're choosing the best answer here. But no worries if you are not sure. All right, I'll wait until number 9 comes in. Okay, cool. So the answer is actually as you receive money. The IRS requires to pay as you go. Remember, whenever you make money, you should be paying taxes. Yes, you can pay it at the end of the year. Yes, you can pay when you file your taxes, but the best answer is pay as you go. Okay, cool. Let's go back to our presentation. And we talked about how to pay. Let's jump into the income tax formula. Remember how I gave you that not very helpful estimated taxes formula? Well, here's the actual income tax formula.